use this liquidity to buy stock because I'm getting net long stock, right? I want to get net long because that's the business that I'm in. I'm trying to be long. And we can develop out these trade clocks. Now, the suggestion is that they change every day so that nobody gets an angle on them. What? How can they possibly change every day so that nobody gets an angle on them? The liquidity isn't for the buyer. The liquidity is who the seller is, right? So whether you want to buy at 11 minutes past 3 is irrelevant to everybody else. Correct? Irrelevant to everybody else whether you want to be a buyer or a seller. In other words, the sellers all come out at the same time every day. Just the same way as the buyers come out at the same time every day. Do you understand? So there is a trade clock. It's maybe not just quite the way one would imagine. And obviously the clock is developed over the course of a day because of what reason? Does anybody remember I said, for example, on oil, if they hold it higher for longer, they're going to sell it at 8 o'clock? Right? So if they're going to hold it higher, for example, if I'm bearish oil and the price is sitting in a balance area and it's coming into, for example, the Brent open, I'm going to say to you guys, right, there's going to be a sell opportunity at 8 o'clock. Start watching for them marking it up into an offer watch and then smash into a quick short, right? So we've already got a trade clock for that individual trade, haven't we? So for example, when I sold oil, what time was I able to sell oil? Did I have a trade clock for oil? Well, I was wanting to get short oil. Did I have a trade clock for it? Well, you tell me. So I want to get short oil and I want to try and get the biggest liquidity, and the biggest liquidity comes from two things: breaking a top edge and hitting a particular time of the day. So in other words, half past or on the hour, half past or on the hour. So we broke the top edge and it was at exactly half past the hour, correct? And because we broke the top edge and it was exactly at half past the hour, we got this big surge in liquidity to sell into, surprisingly enough, right there. And at that stage, the value was good. And the price then proceeded to sell off for a $400, $500 profit for us. You see it? So there is a time log to these elements. And obviously, because there's a time log to these elements, and we started to see, for example, the value of this starting to derive into a 0-point volume value narrative, right? So we can see the red line hasn't gone any lower than this balance, has it? The red line hasn't gone any lower. It's actually gone higher. So if that's going to be the case, when is that trade going to take place? When's your trade clock going to have a massive volume increase? At 2 o'clock, right? When did this break take place? Right at 2 o'clock. Right at 2 o'clock. So the volume's going to pour in. You know that the only trade is a buy trade at this stage. You're going to try and grab it if you're trying to do some business. If you're selling, of course, this is going to be your trade clock exit. It's going to be the volume into that price at 2 o'clock for your exit. And obviously, if you decided it was good enough to buy it, then of course you've just made yourself another $500 back to the upside. So you can see the concept of trade clocks is genuinely correct. But the thing is, this might be a buy stock here and this might be a buy stock here. It might equally be a sell stock if it's a sell day. So even the colors that Reeve's talking about has an element of reference, because the color isn't based on a cycle that you might think that they suggest there is. It's based on the sentiment on that day. It's decided on the day whether they're buying or selling product, right? The same way as you decide on the day whether you're a buyer of this swing or a seller of this swing. So the color of the day is just bizarre. Absolutely bizarre. So there's an element of truth. It's just not that true. It's just not that true. Does that make sense? So, when it comes to program trading, of course, the idea of program trading is that we try and figure this simple concept out of what is a program trade. The idea of program trading is a stock process, and it's almost entirely a stock process back in the 80s. In the 1990s, it was a stock thing. In the 2000s, it was a stock thing. And the reason why it was a stock program was because algorithms were new, right? Algorithms were new, and obviously now we were starting to see this problem that people had was because data was getting put out to a lot more people. Data used to be the world of the big boys, and you used to have a chart without even volume on it, right? You didn't have any information whatsoever. So the data was in the hands of the big boys to make as much money as they possibly could. The playing field was definitely not level in those days from that point of view. So obviously what happened was that when the data started to level up and smaller firms started to get access to things like volume, my God, volume, then of course what happened was that people started to front run the big boy buyers. So when the big boy buyers were trying to come into a market, the idea was that they would obviously manipulate the price down to buy into it, to manipulate prices down to buy into it, and manipulate more prices down to buy into it. So it was an idea that they would do this at certain times of the day to try and achieve liquidity to buy into this, because today was a buy day. Now, these are all very old concepts that have been superseded massively because data became more available for everybody else, right? Everybody else started to get data. So people started to front run the big accumulation trades. And as people started to front run the big accumulation trades, the algorithms needed to find a way of being able to execute across these types of things without getting found, without getting seen. And as people started to manipulate the data, then of course the trading logs, the clocks, the times, the types of days simply ceased almost to exist on a macro chart basis and simply became something more on a very, very, very small time frame basis of a single day. Now, obviously, the idea of program trading therefore also evolved. So the program trades were people who were originally buying stocks. Now, the official definition from the New York Stock Exchange is if you buy a basket of 15 different stocks or more. I think the definition is 2 million. It might be still $1 million. It was $1 million. It might have moved up to 2 million. I don't know. It doesn't make any difference what it is. But the basic idea is that the total value of the stocks needed to be over X amount of money, and it needed to be 15 or more shares, and that was then classified as a specific report called a program trade report. And that's all a program trade was, is a buying of a basket of shares. That's all it was, right? But the point about program trades now has obviously evolved, because then they started to use the same techniques in the futures markets for oil, for futures on equities, for bonds even. There became basically program trades, which obviously doesn't fit into the New York Stock Exchange definition of 15 stocks and $1 million. So the idea of what a program trade is now getting muddied by simply just a normal trade, a normal aggressive trade. But we can still see these program trade spike ideas developing. Yesterday was a great example, actually, on that hold on a second, I'll get the chart. We talked about it yesterday. On the S&P when we were talking about the Prem, remember? And we were looking at these program trade ideas. We were looking at these ideas, these thoughts, these processes. And we were trying to figure out whether the trade was any good, what the program trade meant. And the truth of the matter is it all depends upon what else is happening in the background. Program trades can be stops that might show like a program. Program trades can be genuine sell programs, because 99% of the time, it's to do with one aspect and one aspect only. What is that aspect? Volume. Volume and value. Well, that's two aspects, but you get the basic idea. Volume and value. The idea of getting volume, the idea of getting value, and then the idea of marking prices out of that area. So if we look at, for example, yesterday's S&P, and we ask the question about volume and value and all of those lovely elements, you'll be gobsmacked at how many program trades actually kicked off yesterday. If I can scroll back far enough, and it'll take me about an hour to get there, and the data we may actually run out of data. No, we won't. We're good. Take a look, guys. I mean, this is quite extraordinary because obviously a lot of people, we talked about the Prem yesterday, and a lot of people wonder about this concept of the Prem. But take a look at yesterday. Where were all the program trades yesterday on the S&P? Where was every single program trade in the S&P yesterday? See all these massive spikes to the downside? Well, it depends what you define as a program trade, of course. We could argue that they're all sell programs. Every single one of them is a sell program. It's a sell program from the futures side, of course. It might be a buy program from the stock side, but it's a sell program from the futures side, because obviously if the spike is to the downside, the futures are driving significantly to the downside, correct? In other words, these could all be stop runs, they could all be sweeps, they could all be whatever it is you're looking for. So what's the difference? What's the difference? What makes one a stop run? What makes one a sweep? Well, that's obviously the question, isn't it? That's the question that we need to answer if we're going to use this type of thing. And you can see, interestingly enough, that all of these programs, if you go back a little bit into those programs, you can see that we had a buy program, and then we had all of these sell programs that simply absolutely annihilated the S&P here. Do you see it? Do you see the other thing that's very common about these program buys and sells? What else is very common about these trades? They all have massive spikes in volume, correct? If you just look into the volume chart above, you'll see that every single one of these trades is associated with a massive spike in volume. Now, that's why program trades are genuinely very important, because that volume is going to be used for something. Is it going to be used to accumulate a short, or is it going to be used to accumulate a driving long trade? In this case, is that volume an accumulation of driving short positions, or is it an accumulation of long trades as the price drops through these levels? Well, we don't know. We can know by looking for the reversal that comes in from these, because we shouldn't overlap these areas. And if we do, we've got basically a reversal, right? So when we get a program trade like this buy trade, of course, we can recognize that at first it doesn't seem to reverse the candle. We're just doing halfway through the candle like we did the other day, and then it reverses the candle. So this looks like a short accumulation, and we can trade accordingly. When this program trade comes in here, you see that it never goes past halfway of that entire move there. When this short trade comes in here, it never goes past halfway of that move there. When this short program sell comes in there, it never goes past halfway. And when this program short comes in here, it does go past halfway, correct? It goes past halfway. So if you even think about the trade in line with that storyline there, you'd say, well, we're going short from this point onwards, and we're going to try and work into that as a short storyline. And obviously, going forward from that point, we can obviously recognize that that's also therefore a buy from this point. So in other words, we can use a price action storyline to figure out what it is we're doing. When we get another sell program here, we can obviously watch to see what happens. And again, it goes through halfway. So obviously, again, this is another buyable trade here if you're using price action on its own, and there's another buyable trade from that big sell program. Now remember, the sell programs can simply be what? Sell programs can simply be stop runs. They can be, however, directional drives in the marketplace, or they can be stop runs. The point is, you don't know which one is which. Well, we can start forming an opinion about which one is which by asking questions of, for example, the rotations. Remember what a stock program is. A stock buy or sell program. It's somebody trying to get a basket of 15 shares, right? Somebody trying to get a basket of 15 names. If somebody's trying to get a basket of 15 names, then they must be bullish stocks. They must be bearish stocks. They're bullish stocks or bearish stocks because of sentiment. There must be some sort of beta angle to what they're trying to do. There might be a volatility angle to what they're trying to do, but it's obviously not a volatility trade. It might be linked to volatility, but it's a beta trade, correct? So one would imagine that these buy and sell programs are happening because there's a premium or a discount. Remember, these are buy or sell programs in the futures markets, not the stock. A buy and sell program in the stock markets would be the inverse of these, correct? So we would get a big spike, for example, in the futures, and we would get so in other words, this would be if this is a futures buy program, it could be a stock sell program, correct? So it could be a stock sell program, but obviously if it's a stock sell program, we should see that, for example, on the tick going in exactly the opposite direction to these buy and sell programs. Now, as I said, there's a better and wider way we can look at this, and that is, why would somebody do a buy program if the market was bearish? They simply wouldn't, right? They wouldn't do a buy program unless the market was bullish. So they're trying to find that liquidity. So what we can do is we can overlay this value line, which is obviously our Warren line. It's XLK, Y, XLP, etc., etc. And we can overlay this line, and you can see some of the truth in this storyline. This actually looked really quite good for a buy program. You know, obviously it was coming from this balance. The Warren line had started to accelerate way past the prior levels here, correct? So that was happening before the buy program kicked in. So obviously the stock futures market seemed to be at a discount. So there would be a very good chance in that situation that there's going to be a buy program kicking off from that balance area. Do you agree with that? And we get a very, very big buy program. So you can see that that's happening. But obviously, once they got the liquidity, it still means that we can take an idea about what they did with the liquidity and make a decision. And you can see that the value of the beta line drops off significantly, suggesting, well, that's a good storyline because we'll be able to fill that gap no problem. And we filled the gap no problem. As this divergence took place in here, and we started to see them manipulating the price higher. Why are they manipulating the price higher? To get into position to do a futures sell program, right? Why would they want to do a future sell program from this level? Because this is diverging. So we get an idea that they're probably manipulating it higher to do a future sell program into. And sure enough, the same was true of this one. The same was true of this one. The same was true of this one, but it was not true of this one, correct? You see that? It wasn't true of this one. So this is a perfectly valid sell program kicking off here, still perfectly valid at this stage, maybe confirming that it's valid at that stage, and it's not confirmed at this stage. In other words, the last one is the sweep to get the value buy back into the trade here. And no wonder that trade reversed. This sell program, well, that's not a sell, is it? It's not a sell program. So if it's not a sell program, what is it? It's a sweep of stops. If it's not a sell program, it is a sweep of stocks. And remember what else it might be. It might be a stock buy program. Now, it's not a stock buy program because obviously the prem itself shows when the futures moves, right? You're not going to see a big spike in the prem and the future doesn't move. That's very, very unusual, right? It's nearly always the prem will be futures driven. If it's not futures driven, you've actually got a visible stock buy program. It's not going to show up as a massive spike. It will show up as a futures contract that's not moving. And then you see the prem going in the opposite direction. Now, that gives you a very strong case to buy or sell into the futures because your futures hasn't moved and there is a big buy or sell program kicking off in the stock market. So we've got to be clear that program trading isn't in its simplicity just as you read it in the books. It's a stock buy program, a stock. What you're seeing in that chart is not a stock buy program or stock sell program. It's a futures buy program or sell program, possibly, and possibly simply just a stop run. If you can differentiate between the two, you can make a lot of money trading these setups. Interestingly enough, a lot of money trading these setups. So when you go through that as a process, when you go through that as a process,